Well, gold's glitter is timeless, but this festive season, it's also priceless. With the yellow metals prices touching record highs and silver also following the lead. The question on every investor's mind ahead of Diwali is to buy, to wait, or to look elsewhere. So we are turning the studio into a strategy room. We have gathered your burning questions from across the internet and brought in the sharpest minds in metals to help you invest and crack them open. Well, welcome to this edition of Commodity Champion Special. I'm Nigel D'Souza, and without further ado, let's dive into the festive season's golden puzzle. Joining us on the program today is Feroze Azeez, the joint CEO at Anand Rathi Wealth. Hi, gentlemen. Thanks a lot for joining in. And we've got a lot of queries that have come in there. So let's get straight to the first one that's on the show. We have Ramesh Jain from New Delhi, who brings us this query. And it's a very valid one. He's saying last year has been very good for gold, but, while equities have slumped. Now, the question is, between gold, equities, and fixed assets, what should the split be? Well, Feroze, let's come across to you. What do you make of this? Asset allocation is top of mind. Equity investors, they've been left behind, but most housewives, well, they're dancing away to the bank because they're the ones that have seen a 50% appreciation in gold prices. How do you read this?
Yes, Nigel, when it comes to asset allocation, the classic ways of doing asset allocation, I personally think you have growth assets and protection assets. So if you're going to have debt in your portfolio, at least half the debt of your portfolio should be gold. Like, for example, in my portfolio, or most wealth managers don't have debt in their portfolio. Will gold beat equities over long periods of time? It can still beat Nifty, but the answer is no. So if you look at the 5-year rolling return of gold over the last 15 years, you'll be surprised to see that gold's 5-year rolling return is 8.32% is the mean. And the best case is 18%, 17.99. So what I'm trying to get to is that if your monies are 5 years, then your gold allocation should be half your debt allocation. If you have near zero debt, it's okay to not have gold. That's point. So what should be the asset allocation? I would suggest at least 75, 80% in equity for long-term monies, and the residual divided between debt and gold, 50-50. And if your money is short-term, for example, because gold does beautifully well in the short term as well. So if you look at the 1-year best return ever in the last 15 years, rolling, has been 58% for gold, and minus 21% is the worst. So point I'm trying to make is gold is more of a trading instrument or a debt replacement is what data clearly points out. If you look at on the rolling basis, Nifty beats gold hands down. On a 10-year basis, Nifty would beat. So swap your debt to gold as much as you want.
Okay, all right. Well, we've got to take a short break, but Feroze, just coming across to you, the last 12 months have looked very, very bright for gold as well as silver, while equities have struggled. If you had a 24-month horizon from here on, do you think equities actually outperform from here on, give and take everything? The last year has been difficult for equity markets on various parameters. But the way ahead, would you be betting more on equities doing well? We're talking about a 24-month horizon.
Yes, Nigel. I think like I always said, equities and gold complement each other. But yeah, having said which, I would say that on Nifty also, because you've already gone through a 1-year time correction, almost 7% price correction, 12% earnings correction, I would say that there is some degree of pent-up tension in Nifty for it to move up. The shorts, of course, you track it best. I learned it from you. The FII shorts are at about 92%. If there is any short squeeze, that could be tremendous. In my statistical estimate, 53 lakh crores is supposed to come from domestic institutions in the next 8 years. 15 lakh crores has come. The total free float of the 524 stocks in MSCI small cap index of India is only 34 lakhs. 52 lakhs is expected, crores is expected, 34 lakhs is the free float. So prices, the stocks will transact at a higher price over the next few years. So I would say it will be difficult for gold to beat on a compounded basis 3 years. But having said which, Nigel, quickly, 30 seconds, I checked the worst, in the last 12, 24, 30 months, whenever Nifty was negative, I took the 12 negative months of Nifty, and all those 12 negative months, gold was positive. So I'm trying to create the hypothesis that they are negatively correlated assets and they complement each other. Is the point I was trying to get to.
That graphic plate on the screen, in fact, is telling you the picture out there with regard to when the Nifty doesn't do so well, gold, in fact, has done well, and that could possibly reverse as well. Okay, all right, got that. Thanks for that. Well, before we wind down, Feroze, coming across to you because you've got another query, and the query is: are balance advantage funds better than multi-asset funds, or is it the other way around, considering the risk reward in the current rate cut, gold price for the next 3 to around 5 years? What's your view?
Nigel, I would say to Gautam that a multi-asset fund would be better because the balanced advantage fund switches between debt and equity alone. If you give the fund manager a larger canvas of being multi-asset and moving it around, that will be better. And you would be taking on the advantage, the biggest advantage of delegating it to the fund manager to move between gold, silver, and debt and equity. You are getting a tax advantage because mutual fund managers don't pay tax on any change, right? If you bought an ETF, for example, and sold gold before 2 years, you're going to have marginal tax rate. So point is, you take the multi-asset fund, give them a larger canvas. Having said which, Nigel, I would want to add on how to participate in gold and silver today. I would disagree to invest in ETFs, especially when, like Chirag Saab said, that silver is a tactical allocation. Whenever that is going to happen, when we did a study of buying futures using MCX, the interest cost or the roll cost, as you call it, is just 5-6%. So if it's 5-6%, if I'm going to be investing in silver for 4 months, if I'm tax agnostic, that's the best way to take exposure. One of my clients has 65% in equity, uses 10 rupees of that as margin and goes long on gold 65%. And that reduces the volatility. So that's a better instrument, especially given the fact that all instruments under 2 years will have the same marginal tax rate.
Okay, all right, gentlemen. We appreciate you joining on the show and giving us your take. It's been a healthy discussion. Thanks, Feroze, for joining in and giving us your view on how do you see asset allocation and between commodities as well. What's your view on all of these metals?